Hello, Marc Ostwald from ADM Investor Services International, with some thoughts this week on UK gilt yields and the pound and the announcement that we had on earlier in the week that the Debt Management Office in the UK is going to be issuing a whopping 180 billion pounds worth of UK government debt. Um, just in the period between May and July. Normally, you would consider 180 billion borrowing requirement or issuance requirement, so including refinancing, to be large for a fiscal year. But this is going to be coming because of the measures which have been undertaken to combat the impact of the COVID-19 virus on the economy. So my first chart today is to basically underline a point about why this is probably, to some extent, not quite having the sort of reaction within the UK markets, particularly the gilt market, that one might perhaps expect. First of all, we've got a chart of the UK's debt maturity profile. So this is basically showing where what needs to be refinanced every year, and obviously the key question for this DMO remit for issuing that amount of debt is where are they going to issue. Experience tells us from the 2008-2009 crisis that it'll more likely be shorter. And I think that's important because that probably dictates why we're not actually seeing what one might expect to be a steepening of the UK gilt yield curve. My second chart to amply demonstrate that is the UK gilt 530-year yield spread. As one can see, we've basically narrowed to the lowest levels that we've had since the referendum back in 2016. That's instructive in many ways. In part, it reflects, obviously, the bank's decision to cut rates down to their all-time low. And it also, to a major extent, also reflects that they're effectively doing unlimited amount of QE, which, of course, is one reason why the market is probably not actually reacting that much to this issuance burst. Simply because they know that a lot of the debt which is issued will actually be bought up by the Bank of England as part of the QE process. But I think the more important point is, even amongst all the Brexit uncertainty that preceded the COVID-19 outbreak, actually UK credit metrics, above all for investment grade corporate spreads, which is my third chart today, have actually been largely insensitive to all this. One can see that they traded in a very, very narrow range of between plus 100 and plus 150 for the best part of the last 4 years. The spike that we saw wider is no different to the ones that we saw in the United States and indeed the Euro area in terms of credit spreads, as we saw a big stock market sell-off in March. But with all the central bank measures, so we have crunched that back in. We're not quite back to the levels that we were, but certainly this is hardly premium levels. My question on all of this is, with this amount of issuance, is how much will the DMO be effectively, or the UK Treasury be effectively crowding out the corporate market? And finally, and this is what applies to my final chart, which is a picture of sterling dollar, it's probably going to be the case that the reaction is largely going to be seen in the exchange rate, above all sterling dollar, as has been the case for the past 4 years. Those are the thoughts for this week.